Welcome to this explainer. Today, we are unpacking a really fascinating analysis by Gaston Ray about the LIBRA token case. We're going to be looking at an absolute collision between cutting-edge crypto technology and ancient criminal law. Seriously, it's a scenario where the wild digital frontier literally meets the traditional courtroom, and the implications for how we treat digital assets going forward are absolutely massive.
So I want you to think about this question for a second. Does buying a meme coin mean you waive your right not to be defrauded? It sounds crazy, right? But this single, powerful question sits at the absolute center of a highly controversial Argentine legal case, and it challenges practically everything we think we know about cryptocurrency regulation. Like, does slapping a trendy, informal, technological label on an asset just give bad actors a free pass? Well, let's find out.
To get to the bottom of this, we're going to untangle the illusion of meme coins from the reality of legal doctrine. We'll quickly walk through the initial ruling, look at the core legal errors, dive into the actual timeline of LIBRA, and then see how this all fits into global legal consensus before wrapping things up.
Okay, Section 1, the hook and the ruling. Let's start with the event that actually sparked this whole debate.
On July 3, 2026, federal judge Marcelo Martinez de Giorgi issued a ruling on the LIBRA token that dismissed the private complainants. The judge basically said, hey, this is just a volatile meme coin. But as Ray argues, this ruling makes three massive procedural and methodological missteps. First up, evidentiary circularity. The court is essentially demanding that victims prove the traceability of their crypto before the state has even finished its own expert exams. It kind of puts the cart before the horse. Second is procedural preclusion, reopening the already settled legal standing of these complainants without any new facts. And third, anticipation of merits. The ruling adopts the defense's meme coin theory way before any formal examinations or expert reports have actually been completed.
And making matters so much more complex is the practical effect of this ruling. By sidelining those private complainants, the case is now left entirely to a single public prosecutor's office. And here's the real kicker. That office openly admits it lacks both the budget and the specific technological tools required to trace these complex crypto wallets. So the investigation is essentially paralyzed.
Which brings us to Section 2, object versus conduct, highlighting a pretty fundamental flaw in the court's approach. You can see the clash here perfectly. The defense is using the technological wrapper as a shield. They're saying, look, it's just a meme coin. It's unregulated, it's highly volatile, it's a speculative game. But Ray's theory argues something completely different. He says criminal law shouldn't be obsessed with classifying technological objects. Instead, it must look past the code to judge the actual human conduct. What did the promoters actually do? What representation did they induce in the minds of the investors?
And this is rooted directly in Article 172 of Argentine law regarding fraud. Under this law, fraud doesn't actually interrogate the object being sold. You can sell a completely real, functioning blockchain token, but if the staging around it, the mise-en-scene or the artifice, is built on deception to get someone's money, well, that's fraud. The law judges the staging, not the object.
So, moving on to Section 3, the LIBRA reality. If the law cares about the staging, what exactly was the staging in this specific case?
When we lay out the timeline objectively, things get really interesting. This looks absolutely nothing like a normal meme coin fluctuating on random community sentiment. Just look at this highly orchestrated sequence. At minute 0, the token launches right alongside a social media post from the president's account, directly linking the specific smart contract. By hour 4, a very small group of pre-positioned insider wallets starts making early withdrawals. By hour 12, total price collapse of the LIBRA token. And then by day 2, the presidential post is deleted, followed by a denial of prior, documented meetings with the developers.
Analyzing all this evidence neutrally, Ray points out these highly specific objective indicia of fraudulent staging. It wasn't pitched as just a joke. The Viva la Libertad project actually promised real economic financing for Argentine businesses. You had the exact smart contract link pushed out via a presidential account at launch, which fused a private crypto venture with the illusion of highest-level quasi-institutional backing. Plus, there were documented prior meetings between the developers and the head of state in official logs. Ray even flags a procedural concern, noting that the timing of the judge's ruling aligned with a family member's appointment in the executive branch, which raises concerns about objective impartiality. This whole setup, this is the mise-en-scène in full effect.
And, as the author brilliantly points out, you can't just blame an investor for being gullible when the pitch literally includes a direct, verifiable endorsement from the head of state. Assessed in the concrete reality of the situation, that kind of staging is objectively suitable to induce a false representation of reality. It's designed to make you trust it.
All right, Section 4, the market risk fallacy. The defense leans heavily on this idea that crypto investors just took a gamble and lost, but that leads us to a crucial legal concept. To explain why volatility never absolves fraud, Ray uses German criminal doctrine, specifically the concept of risk transactions, or Risikogeschäfte. German law draws a very hard line here. It distinguishes between the normal risk inherent to an investment, the accepted reality that markets go up and down, and the illicit risk created by an antecedent or prior deception.
The key difference is the timeline of the deception. Think about it. Buying a volatile stock and losing money? That's market risk. That happens after you make an informed decision to participate. But fraud? Fraud operates earlier. Buying a stock based on a fake corporate prospectus is fraud, because the deception corrupted your decision-making process before the market even played a role. You didn't just assume market risk. You were tricked into entering the arena in the first place through a false representation. Okay, moving to Section 5, global legal consensus, because this distinction isn't just some isolated Argentine theory or an obscure German doctrine.
This is actually a recognized standard worldwide. Across different jurisdictions, courts uniformly reject the excuse that crypto market volatility just cancels out the existence of a fraudulent scheme. Look at the U.S. In the 2013 Times SEC v. Shavers case, the court found that the informal character of Bitcoin doesn't immunize promoters from standard financial fraud rules. There's even a pending U.S. class action in New York actively examining this very LIBRA token, specifically looking into token inflation and those early insider withdrawals. And over in Spain, the Arbistar case ruled that crypto volatility is merely an accessory feature. What truly matters is the intent to deceive via staging.
This naturally brings us to the famous U.S. Howey test. Because the LIBRA project solicited capital for small Argentine businesses and promised returns, under the Howey test, it functions exactly like a regulated investment contract. There was an investment of money, a common enterprise, and a reasonable expectation of profits derived from the efforts of others. The fact that it was wrapped in a blockchain token doesn't change the economic substance one bit.
I love this quote from the analysis because it perfectly captures the overarching theme of this explainer. It doesn't matter how new, informal, or complex the technology seems to be. The fundamental rules of financial fairness and criminal law still apply. The courts must examine the economic substance of the operation, not its digital wrapper.
Finally, Section 6, Conclusion. Let's pull all these analytical threads together.
If there is one single thing you take away from this explainer, let it be this. Economic substance always overrides the technological wrapper. Criminal law must never be blinded by the latest digital buzzwords. A scam is a scam, whether it's executed with old-school paper certificates or a fancy new smart contract.
For the justice system to properly handle complex cases like LIBRA, Ray argues they need to shift their analytical focus using these exact steps. First, stop getting distracted by the asset taxonomy. Stop using words like meme coin to prematurely dismiss cases. Second, investigate the induced representation and the staging. Look at the marketing, the institutional endorsements, the promises made. And third, uncover the architecture of fraud hidden beneath the code.
I'm going to leave you with this final thought to ponder. Because let's be real, LIBRA certainly won't be the last time an old scam tries to hide inside new technology. As these new technological wrappers continue to emerge, will our legal systems be blinded by the code, or will they learn to always look for the human conduct beneath? Thank you so much for joining me for this explainer, and keep asking the right questions.